Good afternoon once again. Um, Today's video, we're going to talk about basic terminologies in forex trading. Okay, there are basic terms that, as a beginner trader, you should be able to understand. Okay, um, yes. So, on the financial markets, okay, Uh, these are just the basic terminologies that you must familiarize yourself with so that you'll be able to trade accordingly. So the first thing, we all know that on the forex market, we buy and sell currency. We exchange currency, one currency for the other. Okay, yes. So in the forex market, when you say go long mean that you should buy. You should what? Buy. So just in the mere market, you use buy. I'm going to buy this, I'm going to buy that. In the forex, we say you are going to what? Going long. So you go long on the forex market. And then if you are going to sell, if you are selling a currency for the other, you do what? You go short. Okay, so you go long or you go what? Short. Or long is the same as you buy, and then short is the same as what? Sell. Okay, now whenever you take a currency pair, you see in the forex market we have the currencies that are being paired. So this currency paired with the other. So for example, we have a euro USD, means that euros being paired with what? US dollars. Okay, so euro USD is a currency pair. Okay, so the euros, which is the first on your left hand side, which is the euro, is called a base currency. Base currency. Base currency. And then the dollar is called what? Quote currency. So usually the quote currency is used to buy the base currency. Okay, so we have base currency and then we have what? Quote currency. So the currency on the left side is the base currency, and then the one on the right side is the quote currency. So in the case of euro USD, the euro becomes your base currency, and then your USD becomes your base currency. Okay, so you must know what quote is and then what base is. So quote is the US dollars, or the currency that is on the left side of the pair, and then the base is the one on the right side of the pair. Okay, all right. So the next one I want you to know is spread. Spread in forex. Okay, spread is the charges that your brokers charge you. So whenever you place a position, your broker or the bank you trade with charges you for every trade you place. Okay, so that particular charge is what we call the spread. Okay, so in between the difference between your selling price and then the buying price becomes the charge. Okay, and that is what we call what? The spread. So in the forex market, spread is basically the charges that your brokers charge you whenever you place a trade. Okay, yes. Then we have a bid price. Bid price is also known as buying price. Bid price is also known as buying price. So when you take the forex charts, okay, you will see an area that is being demarcated as a buy order, and then we have an area that is being demarcated as what? A sell price or buy price. So these areas, the buy one is what you call the bid price. Okay, so on the chart, the area where whenever you place a market order, it's placed, especially when you place a buy market order, where the market automatically buys for you becomes your bid price. Okay, that is the buying price you are buying that currency at, and then the ask price is the selling price. So if you are willing to sell your currency, then the price that's the on the chart, the price that you sell that currency at becomes your ask price. Okay, so ask price is the same as selling price, and then bid price is the same as what? Buying price. Okay, so the next terminology we're going to talk about is pips. 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 P-I-P-S. Pips. Pips is a unit of measurement that is used to calculate the change in the prices of the currency. Okay, so it's what we call a unit of measurement used to calculate the change in price of the currency pairs on the forex market. So that is your pips. So usually the pips, when you open the market, okay, you will see some values that are moving up and down, changing here and there on the market, and that becomes your pips. Okay, the higher the pips, the more liquid that currency is. Okay, and then the lower the pips, the less liquid that currency is. Now, traders use pips to calculate profit and losses. So if you want to know your profit, you can use the pips, okay, to know your profits. And then the pips can also be used to know your losses. Okay, yes. And then the pips can also term as percentage in points. Percentage in points. So in our next video, I'm going to take you through how we calculate for pips. How to calculate what? Pips on the forex market. Okay. Mere name, lost place. Okay, that's fine. Okay, so that is it. Pips are points or percentage in points, and it's a unit of measurement used to calculate change in prices of currencies in the forex market. Okay, so that is pips. So if you want to know your profit, if you want to know your loss, you check what? The pips. So for example, when you place an order, okay, as the market moves in the direction of your order, the numbers that are changing over there becomes the pips. Okay, so as it moves in your direction, that numbers that will be changing, it becomes your pips or the points. So if you want to know maybe your profits, you can use the number of pips that your position went to determine the profit you've made. And also, if you want to know your loss, then you can check the number of pips that the market moves against your direction. Now, we have different types of market orders. We have different types of orders on the forex market, and depending on which one you want to use. Okay, so we have a market execution. So when you open, let me say, your MetaTrader 5 app, okay, and you want to place an order, the you will see market execution. The market execution means that you are going to buy or you are going to sell with the current market price. The current market price. That is market execution. So when you use market execution, meaning that you are buying at the current market price. Okay, yes. Then the next one, we have what we call a buy limit. a buy limit order. Buy limit order. So buy limit order, what happens is that the order or the buy order or the long position is placed below the current market price. Below the current market price. That's where the buy limit order is placed. So the current market price, you place your order below it. Okay, that is buy limit order. You open the charts and let me say the Bitcoin price currently is, let me say, 100,000, but you do not want to buy the Bitcoin at 100,000, but you want to maybe buy it at 99,000. Then you have to use what you call the buy limit. So you place it below the current market price, and when the market reaches there, drops and reaches there, then it buys for you. That is what you call a buy limit order. And then the sell limit order is also, you place a sell order above the current price. Okay, so for example, Bitcoin, the current price of Bitcoin is $100,000, but you wouldn't probably want to sell your Bitcoin at that price. Okay, so what you want to do is that you want the price to go up a little bit before you sell. So you place your sell limit order above the current market price, which is the 100,000 US dollars. So when the market reaches that market order that you've placed, then it will sell for you. That is what sell limits. So markets or order is being placed above the current market price. So as markets move and then reaches that area, then the market or your order will be triggered and it will sell for you. So that is sell limits. Then we have a buy stop order. A buy stop order. Buy stop order. So buy stop order is a pending order that is placed above the current market price. And let's look at what happens over here. Buy stop. So when you say the market is moving in an uptrend, okay, there is a bull market. Market is just moving up like that. And you don't want to buy at the current price, okay, but you believe that when the market maybe rise up a little bit, when it get to a certain particular price, the market will continue to move higher. So what happens is that you place your market or your buy order, that is your buy stop order, on top of the current market price. So when the market moves and then reaches that particular order, it will be triggered. So what that means is that when it triggers, the market is supposed to continue to move up, and as it does that, you make profit. But if the market reverses at the market price that you placed, then you make a loss. So buy stop, you place the order above the current market price. So for example, you want to buy, so you place your order above the market price. Then when the market reaches that market order or the market price, then you are saying that the market should continue to move up. And as it does that, you make profit. That is a buy stop market. A buy stop market order. Then we have a sell stop. Sell stop is the opposite of a buy stop. So the sell stop, you place your order below the current market price. So for example, in a bear market or in a downtrend market where the market is moving down, okay, but you wouldn't want to buy it at the current price, and you believe that when the market drops and get to a certain market price, it will continue to move downward, so you use what you call a sell stop order, sell stop pending order. So when market moves down and reaches that particular price that you've ordered, it will be triggered, and as the market moves downward, you make profits. That is a sell stop. Then we have a buy stop limit order. It's quite confusing. Buy stop limit order. So we will do I'll do a video on how to execute these orders. Okay. All right. So we have a buy stop limit order. Buy stop limit order. It's an order, or it's a pending order that is placed below the price and then goes up. So let's do this. When market is you have a bull market, okay, when you have an uptrend market, a market that is moving up, up, this what is that? You know, on the forex market, the market doesn't travel direct to um the level that we are expecting. What it does is that it moves up, down, and then gradually moves up, or gradually becomes bullish. So when it moves and then it creates that higher high formation, which is in an uptrend, markets will reach a certain level, it will pull back for correction, then it moves up again, then come back a little bit, move up again. So in the buy stop limit order, usually we place it, or we use it in a trending market, in an uptrending market. So what happens is that you place your order just below the price, and then when the market moves up and then drops down a little bit, or when the market drops down for correction before it moves up, you presume that the market will probably drop to a certain level before it continues to move up. And so you place your order at the level that you think that the market can drop and reach that area before it continues to move up. So you place it over there, expecting that the market will drop and reach there before it continues up. That is a buy stop limit order. It's very important. Buy stop limit order usually it's very useful when traders expect an uptrend price. Okay, they expect that an uptrend will continue. Okay, yes, then you use a buy stop limit order. It helps traders to manage their risks and control timing of orders. Very important. So buy stop limit order helps to manage risks, okay, and also control your timing for your orders, okay. And traders also buy stop limit orders help traders to avoid emotional trading. You know, emotion is part of trading, whether you like it or not. Sometimes you become so emotional, especially when you've lost some positions and all that, you've lost some money, become so emotional that you may not know where to even go into a position. So to avoid that, you use a buy stop limit orders. Now, the next terminology I want you guys to take notice of is leverage. Leverage, very important. Leverage is a loan, okay, the loan that forex brokers give to their clients, okay, so that they will be able to trade a large account. So for example, when you have a small account, maybe you have just some $10 in your account, you have some $20 in your account, you know, that account is very small, very small account. So you can't trade that much with that account. So leverage is the money that your brokers borrows you so that you'll be able to trade a large account. Okay, the higher the leverage, the higher you are, able to make profit. And also, the higher the leverage, the higher your risk. Okay, yes. Then the last one is margin. The margin is the amount of money you must put into your account so that you can open and hold a certain position. So let me say, for example, you want to maybe buy a Bitcoin and you need a certain amount of money in your account so that you'll be able to hold that position until the market gradually gets to the order, get to your take profits. Okay, so your margin is the amount of money you put up in order to hold a position. Okay, so these are the basic terminologies that every beginner trader must know and take notice of. Okay, yes, don't forget to subscribe to my YouTube channel, comment, share for others to also learn. Okay, learn something new. Learn something new now. The earlier you do it, the better. Okay, try to learn something new. Doing one job in this modern time is not the best option. So you can't be doing Forex as a side job. Okay, side job. Okay, so if maybe you are so busy that you don't have time on the Forex market, then you have to choose a trading style that will match with your lifestyle. Okay, so let's if you are interested in joining Forex, you can click on the link below and then register with us. Don't forget to subscribe and share, and then let others also learn. Okay, all right, so you can join my Telegram group, and then if you have any question you can ask, and I'm always available to teach you. Thank you for watching. See you in the next video. Don't forget to subscribe. All right then, bye bye.